SMA pre-released their figures this morning, and in a very nice turn of events, they actually increased guidance for next year, following an EBITDA loss in 2024 of about 1% margin. They increased their target to 6% at the midpoint of guidance, and this is supported by the strength of their large scale and project unit. This is, a very big business for them, and it's picked up a lot of the slack from the home stuff that's been happening in Europe. For those of you who don't know, the residential space, particularly solar in Europe, has been facing a lot of inventory headwinds.
There's been a lot going on in the last couple of days in the world of oil. Oil was down intraday at some point yesterday by about 4%. It's down another 2% today. Brent is now below $70 a barrel. And it's partly, and I think mainly driven by the news that we had, the announcement that we had from OPEC Plus Monday evening. And the announcement was that the group is going to proceed with its planned output hike of about 138,000 barrels a day of oil starting in April. So a couple of things here. I mean, you might be thinking, this was the plan anyway, and it's only 138,000 barrels a day in April. So, it's, in the grand scheme of things, that's a small amount. So why would this be so important, and why would this be moving the market? And it's important because this was the plan, but it was not the consensus. The consensus was very much for the group to delay this output hike for at least a month, but more likely for another quarter.
The OPEC's becoming a decreasing part of the global production since I think they were about 40% 20 years ago. Now they're dropping to 25%. The trend is clearly that OPEC just doesn't matter as much anymore. What matters most is in the macro big pictures. What we're doing is called the low price cure. Big picture in commodities, they go down because they went up a lot.
Earnings season right now, we're getting 2025 outlooks. And the majority of those outlooks on the oil side is for tepid growth of output for oil. But a lot of the programs are being priced around the $70 range. And so WTI right now, it just hit the 65 level, back across to 66. At $60, operators need to reassess some of those ancillary production targets.
Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's PI Energy Exchange. I'm doing it live from the big Bloomberg Invest 2025 summit in New York City. And on the call today, just quickly running around the world, we've got Salih Yilmaz joining from his usual perch in Dubai and swinging across to London. We've got Alessio Mastrandrea. Then jumping across the pond, we've got Mike McGlone joining from his perch in Miami, and Vince Piazza, who's currently in Philadelphia, but on his way to New York for an event that we're doing here in New York this afternoon. So for anyone coming this afternoon, we look forward to seeing you in person. And if you are in New York and we didn't know we were having an event this afternoon, reach out. We're happy to get you the details and happy to have you join us. So Salih, I want to come over to you first and just get your pulse on commodity markets here at the moment. A lot has transpired over the last couple of weeks. What do you make of the latest news from OPEC?
Sure. Thanks, Rob. And thanks for having me on a little bit last minute this time. I really appreciate it because there's been a lot going on in the last couple of days in the world of oil. Oil was down intraday at some point yesterday by about 4%. It's down another 2% today. Brent is now below $70 a barrel. And it's partly, and I think mainly driven by the news that we had, the announcement that we had from OPEC Plus Monday evening. And the announcement was that the group is going to proceed with its planned output hike of about 138,000 barrels a day of oil starting in April. So a couple of things here. You might be thinking, this was the plan anyway, and it's only 138,000 barrels a day in April. So, it's, in the grand scheme of things, that's a small amount. So why would this be so important, and why would this be moving the market? And it's important because one, this was the plan, but it was not the consensus. The consensus was very much for the group to delay this output hike for at least a month, but more likely for another quarter. And secondly, the amount for April may sound small, but that would be the first increase of more increases to come every month, and which would accumulate, and throughout the year it would be a more significant amount. So I think what's important to note here is that this OPEC plus policy and the delays that they did for 3 times in a row was essentially their downside protection for prices. They kept this tight grip on supply. They delayed these output hikes when they needed to, given the outlook for soft demand and quite robust growth from non-OPEC plus supply, which didn't really change, but they are deciding to go ahead with the output hike. So that price floor that they may have been protecting, which we were arguing was around $70 a barrel, that price floor is probably gone. And as I mentioned earlier today, Brent did actually fall below $70 a barrel now. So very briefly, I mean, why is this happening now? One argument that's been reported is that the decision may have been swayed by the calls by US President Donald Trump. I mean, in his speech to Davos a few weeks ago, he was calling on the group to increase output and bring down the cost of oil. So that could be part of the reason. And that's kind of the supply side, I think, the main driver. But very briefly, also to mention, this is combining with, of course, all the tariff news that's been quite an overhang on the wider markets. But it is, I mean, the tariff news are very important for oil, of course. More tariffs, expanding trade wars would mean less trade, would mean less oil demand, and is obviously a downside catalyst for prices as well.
Okay, let's bring Mike McGlone into the conversation. Mike, you've had a fairly bearish call for some time. How does the latest pronouncement that Salih was just talking about from OPEC feed into your thesis?
Noise. Unfortunately, OPEC's becoming a decreasing part of that global production since I think they were about 40% 20 years ago. Now they're dropping to 25%. The trend is clearly that OPEC just doesn't matter as much anymore. What matters most is in the macro big picture is what we're doing is called the low price cure. Big picture in commodities, they go down because they went up a lot. And to let you know, the very simple examples, not just crude oil. I'm in Chicago this week. I was at the all-day ag outlook yesterday. I've been going to this for 3 decades. And the key quote I got out of that was seriously large when they're talking about soybean production in Brazil. That's on the back of the massive pump and prices to 2022. So we're in the back end of that. And now we're seeing the macro kick in. We have increasing supply out of US, Canada, South America, OPEC, you name it, and decreasing demand from China. And as we proliferate with EVs, my EV is 11 years old. This is just starting to kick in. And one key force we saw kick in a little bit yesterday for the first time in about 18 months, the S&P 500 kissed its 200-day moving average. So that's the key risk, is if we get a little more backup in the stock market, which, by the way, Salih did mention, President Trump mentioned his presentation yesterday that we want lower energy prices, we want lower yields. He did not mention the stock market. We all know that's kind of the key risk. So I think it's a matter of time crude oil does and commodities do what they always do historically. Is they have to get below their break-even costs. In the U.S., that's $56 a barrel approximately. Typically have to get below that. We've done it quickly in grains, we bounced. We've done it quickly in natural gas, and we bounced. And to me, this is the macro big picture. So we have unemployment on Friday. Anna Wong, our chief economist, is looking at the risk. There could be a negative number. We have the world's most significant money liquidity provider and employment provider, the U.S. government, in Doge, is cutting off significantly. So to me, this is a normal pattern. I think the peak is in for crude oil around 80. I think the next stop is around 60. And I think you got to get cheap. And that cheap will come on the back of maybe a little backup in U.S. stock market when all risk assets go down. You also see it to me in bond yields. I would just point out, don't underestimate this U.S. government. They want lower energy prices. They're going to get lower energy prices. And they have all pre-existing trends in their favor. So I'm looking for something like tweak that view to the opposite, something that might surprise me. Otherwise, to me, this is a normal trajectory. It's taking a lot longer than I thought. But again, this is a key thing we're going to find out by the end of the week. If that S&P 500 can stay above its 200-day moving average, maybe crude oil will stabilize. If it breaks down, your next stop is $60 a barrel.
Okay, Vince, let's bring you into the conversation. What do you make of the developments from OPEC? I'm curious to get your sense on break-evens, and how do you think the U.S. oil patch is going to react to increased supply from other regions?
Well, we're in earnings season right now. We're getting 2025 outlooks. And the majority of those outlooks on the oil side is for tepid growth of output for oil. But a lot of the programs are being priced around the $70 range. And so WTI right now, it just hit the 65 level, back across to 66. At $60, operators need to reassess some of those ancillary production targets. But again, we're still talking about fairly low output growth. $70 seems to be that Goldilocks level on WTI, where these operators still feel quite comfortable. I think what will end up happening is this $60 range, $70 range still offers the operators an opportunity to throw off some free cash flow. Debt is not that bad heading into 2025, so leverage isn't going to be an issue. I really do think you're going to see sort of like this stasis period for a lot of the oil operators. What's really interesting to me in the action over the last couple of weeks is what we've seen in natural gas. Hello, gas is up. Natural gas is up 20% year to date. And that's on the back of a pretty cold February. Weather is normalizing here in March, but you're still looking at spot well above $4. Prompt month is staring at almost $4.40. So we really got a little boost for operators that are exposed to both oil and gas. While it hurts on the oil side, they're getting a little bit of a bump for free cash flow, considering where Henry Hub is and a lot of the regional price differentials.
Vince, I want to follow up because we held an event, Mike McGlone had an event in Miami last week, and we specifically got questions on the gas front in the context of EQT. And I promised we were going to have you on to talk about them. So I think if you could generally frame your thesis on that company, the folks who were in attendance for that meeting would greatly appreciate it. And I can see some of them are on the call today.
Absolutely. So if you think about the streamlining process that we've talked about for quite some time now, EQT was a larger conglomerate. It had a utility, it had pipelines, it had pieces of the Marcellus as well. So over the course of roughly a decade, it streamlined its asset base, sold off the utility, IPO'd the midstream components, and became a pure play natural gas E&P in what is the most economic play in North America, economic gas play in North America. Over time, it consolidated the North American Marcellus shale. In general, the Appalachian Basin was its primary focus, and it became one of the largest players. Now, it has sort of tried to put back its organizational structure from years ago. It bought in the midstream component, which tends to sort of cloudy the narrative, the streamlining narrative that we have been great supporters of. But in general, it is one of the more pure play operators in Appalachia. If we want to talk about Appalachian natural gas, we can't talk about that without talking about Expand Energy, which recently leapfrogged EQT with its acquisition of Southwestern. It's now the largest pure play independent natural gas operator in the US. And so those two are really competing for mind share on the natural gas side. EQT has decided to bring back some molecules in 2025. They curtailed molecules back in 2024. It seems to be a fortuitous move on their part, since we're staring now somewhere around the 450, 460 range throughout 2025. And it's going to need that because the balance sheet is somewhat over-levered, given the acquisitions relative to the peer group and relative to where Expand Energy is. So it's going to need that higher benchmark price to delever in 2025. But both EQT and Expand are two names we've talked about frequently for those that are more bullish on natural gas, just because of their leverage to the most economic gas play in North America.
Okay, thank you, Vince. I know you got to go catch a train, so if you've got to depart, very great to have you on, and we'll see you in New York this afternoon. Alessio, I want to switch over to you and continue the company coverage discussion. So we're about midway or more than halfway through the reporting season for the wind and solar names. And in the solar space in particular, I think it's been a fairly mixed bag. We've had some good news from some companies and some challenging news from some others. So can you give us your lay of the land? Particularly, I'm thinking SMA, inverter manufacturer, out this morning. Tell us what you heard on their guidance. Compare that with Sonova, First Solar, and some of the other names in the space, please.
Sure, thanks, Rob. So yeah, just to start with the pretty positive news, SMA pre-released their figures this morning, and in a very nice turn of events, they actually increased guidance for next year, following an EBITDA loss in 2024 of about 1% margin. They increased their target to 6% at the midpoint of guidance, and this is supported by the strength of their large scale and project unit. This is, a very big business for them, and it's picked up a lot of the slack from the home stuff that's been happening in Europe. For those of you who don't know, the residential space, particularly solar in Europe, has been facing a lot of inventory headwinds, and a company like SMA, which has both utility and homes, was able to pivot their business, and they even had a joint venture on batteries that kind of helped buoy up their margins. On the First Solar side, they also had a very strong end of the year. They've got a backlog of about 68 gigawatts, which is fully sold out through 2026 and partly through 2027. They're going to see their top line increase about 30% this coming year, and that's despite project delays that have been plaguing other utility scale manufacturers like Array and Shoals. Now to kind of shift to maybe some of the worst news of the week. Sonova's share price fell 70% because they cut their cash generation guidance in 2025 and 2026. Previously, they were going to make between 300 and 400 million over the next 2 years, and they had to cut that to focus on their 2026 debt maturities. They currently have 1.3 billion in total current liabilities and only about 200 million in unrestricted cash. This is basically because they are heavily reliant on tax equity and asset-backed financing, and this was really challenged by the election. Project financing markets have really just taken a pause just to see what Trump's going to do, what's going to happen to solar projects in the US. And this resulted in the tax equity funds being delayed, triggering a going concern warning. So what have they done as a result? They've done a restructuring plan, laid off 15% of their staff since February and 30% since 2023. They've shifted focus on higher margin leases and PPAs, and they're looking to stabilize margins because historically they've done a lot of loans, which is less profitable, and now they're really focusing 100% on these leases and PPAs. And then just to end on a bright side for the company, they've got solar management is up 20% on the year to 3 gigawatts, and their battery storage division is up 50% to 1.6 gigawatt hours.
Okay, thank you, Alessio. Before we kind of zoom back out and talk more macro, I want to continue the company-focused discussion. Salih, I was just reading that Saudi Aramco has cut its dividend guidance, I believe, for 2025. What do you make of that? How does it feed into your thesis on the company?
Sure. Yeah, so Aramco reported its results yesterday. I mean, the earnings were pretty much in line, but as you alluded to, dividend guidance was what we were focused on, what I think a lot of the investors were focused on. And as we expected, there was a massive drop in the guidance for the special dividend part, the performance-linked dividend part of their total payouts. And just to give a little bit of background on this, they introduced this performance-linked dividend following the windfall profits that they had in 2022. They wanted to share that upside with their shareholders, and that's what they had. And in 2024, they paid in total dividends of $124 billion, which is obviously a massive number. The guidance for this year is going to be $85 billion. So, and about 84 billion of that will be the base dividend. So the special dividend is essentially going down from about $40 billion down to about $1 billion. But this was within the guidance. I mean, the way they introduced this was the special dividends will be calculated from the profits of the previous year. So in 2024, the previous year was very profitable, so they actually end up paying a lot of special dividends. But this year, using that same formula for the profitability from last year, that performance-linked dividend part is going to be much smaller. And of course, this has implications for the kingdom, and the way we were viewing this was very much of a trade-off for the kingdom and for Saudi Aramco, because still 80% of the company is owned by the Saudi government, which, as I've discussed on this call many times before, is going through a lot of transformation projects at home, and they need the funds mostly coming from Saudi Aramco to fund these projects. So Aramco essentially had to choose between kind of protecting its balance sheet, cutting that special dividend part of the total payout, or keeping funding these government projects, and they essentially opted to make sure their balance sheet remains solid, their gearing doesn't keep going up to more alarming levels. And that being said, I mean, their gearing is currently at just below 5%, and that compares with about 15% in the global peer group. So it's not at all at alarming levels, but their move of massively cutting that special dividend shows that they do care about their gearing perhaps staying in single digits.
Okay, thank you, Salih. So for anyone listening, if you aren't subscribing to Salih's research, make sure you look him up on bio. You can get his reacts when he puts out information or new updates his thesis on Aramco, the oil market. Same for Mike, same for myself, same for Ben, same for Alessio. We are always regularly reacting to new information in the marketplace, like what Salih was just describing, or sharing our views. I want to pivot over to.
Thank you, Rob.
Actually,
sorry.
Salih's got an additional point.
Yes, sorry about that. I'm sorry to interrupt, but before I forget, one plug, if I may, is very quickly, I will put this in the chat right now. We are running another oil market survey. I know that these are generally very well received and very well liked by clients. I think our clients really like taking part in these surveys, and I think they really like seeing the results of this survey. So I'm very sorry to interrupt, but just wanted to give a heads up that I will share the link in the chat now, and it would be great if you could take that survey when you can. It's anonymous as always. It only takes a minute to complete. So again, sorry for the interruption, but just wanted to, before I forget and before the call is over, I wanted to make that announcement.
Thank you, Salih. I knew there was something I was supposed to plug that I was forgetting. I highly encourage everyone to take this. We've been asking you, our clients, for years now, when you think oil demand's going to peak. And I know that it's sort of like an interesting question. In many ways, it doesn't matter. Still has to invest because of decline rates, even if oil demand is going down. But it's sort of the pulse, the vibe on that question, I think, is interesting. But plenty of great other ones in there, and I know I always look forward to looking to see what all of you think as well. So, Mike McGlone, let's swing back around to you and bring back out to commodities. Okay, so Vince had a pretty good story on gas in the U.S. Mixed bag, but leaning towards good on the solar space from Alessio. A little bit of challenges for the likes of Aramco that Salih was talking about. What's your general sense on commodity trajectory, Mike, for 2025, 2026? Does any of this company news change in any way how you think about the overall?
Yeah, I got most of that. I think Sally nailed it with Saudi Aramco, the need of revenue. I mean, it's what we do in this space. I'm out in the Corn Belt, I used to own a farm, and it's just one of those lessons when you got land and you can produce income from it, which is what's happening in the U.S. Shale belt, is you do. So the mail and we're coming back in. We're on the back end of a very historic pump in prices on the back of a significant invasion, which to me was very similar to Iraq's invasion of Kuwait, and then those downward trajectories usually last for years. So specifically, this is not just isolated to crude oil. Now, natural gas has had its bounce. It's great. It's above $4 per MMBTU in the U.S. But the lesson we've learned in natural gas, particularly with our new deregulation type president, is every time it gets above 4, the supply comes on and it pushes it back to 2. Maybe it's different this time. Managed money net positions are on top of that trade. They're long. That's a bit risky. Crude oil, the same thing. It typically have to get cheap. I don't know where that stops. I like to point out one thing that's really going up. The key thing I'm still bullish in commodities is gold. That gold to crude oil ratio at 44 barrels of WTI to gold right now is the highest since November 2020. Remember, that was the most significant money pump in history, and it's a bull market. So there's at least a bull market I think is going to continue. Gold versus every commodity, gold versus even the stock market's breaking out. And that's as we just get to this normal reversion in what's been a very historic rally in all risk assets. So to me, that's the macro. Commodities are tilting towards that deflation. You're seeing that in bond yields. You're seeing that in Chinese bond yields. A significant, I think the best thing to look at in the macro is what's happening in China 10-year at 1.76. Now the US is narrowing there. I think the US 10-year is going there. And our government wants it that way. So I look at corn, looks like it just put a pretty good peak around $5 a bushel. Soybeans look like they put a good peak just around 11 heading to 9. They're oversupplied markets. The one that's only standout that's unique is copper, and that's the US dollar copper price. Right now at $4.80. It's just above the highest month-end close ever, 475. If it can sustain that above that level, it means it's showing demand pull forces, but we all know that's not the reason it's happening. It's a major spread versus the LME copper because of U.S. tariffs, which is probably going to bring on the lower price as the U.S. this copper just goes to fill those inventories. Right now it's distorted. So that's the key one I'm really watching, but it's distorted. We'll see what happens with Friday's payroll. And I'll end with this. To me, it's just the normal trajectory for commodities, normal to get cheap. Crude oil's on that trajectory. I don't know what stops it. Gold is going to continue to go up to around $3,000 an ounce. I don't know what stops that. But a key thing I like to point out is you look at gold versus U.S. Treasury bonds, or treasury bond gold, it's the highest ever in our 30-year basis. If you look at the stock market versus treasury bonds, again, the highest ever. So to me, the next trade is our government, our president getting what he wants, lower energy, lower yields, and Friday's number might be an indication to kick that off. For that not to happen, the number one thing you need is U.S. stock market to keep going up, and that looks like we're seeing a little cracks in that armor.
Mike, I can't help but notice that over your shoulder, Steve Mnuchin is on the TV screen. He was just sitting across from me a minute ago here at the event I'm at. So it's fun to see this small world unfold. You talked a lot about ags. Can you tie that into energy? What's going on with the biofuel markets? How does your thesis on soy, corn, et cetera, feed into that energy tie-in, given we use a fair amount of biofuels here in the U.S.
So that's a key thing I wrote about years ago. If you're a commodity bear, start by blaming the U.S. A massive amount of superabundance coming out of the U.S. Excess supply of crude oil and liquid fuels. Biofuels a big part of that. Basically, 1/3 of our corn crop is used for ethanol. We export a lot of it to Canada. So we might have a glut if Canada cuts that off a little bit, partly because we can do it cheaply, have this major resource. Almost 15% of U.S. unleaded gas in this country is now sourced from ethanol. And that's actually U.S. unleaded gas demand peaked years ago. It's heading lower, particularly as we head towards EVs. So to me, the whole space is we're bringing, and the takeaway I got from the Ag Outlook is we absolutely need more programs from the U.S. to mandate more biofuels, or the U.S. farmers have a big problem. They can't really export anymore because Brazil's beating that market. Our dollar's strong. China demand is actually declining, partly because they're switching to genetically modified seeds and increasing their own supply. So it's just a bad big picture macro. You basically need a drought in this country for higher prices. But it's the lessons of Jeff Booth, who wrote in his book The Price of Tomorrow. And this technology is moving so fast, we can create massive supply, and we're doing it. And we had the incentive of that big pump because of Russia's invasion of Ukraine. So to me, the macro is biofuels are coming on. You absolutely need that to use more of our crop for biofuels. And I do love the pushback I get from some people when they say, oh man, why are we using our food for energy? Well, there's a problem now. We're actually getting near and below cost of production in this country for most of these grain prices. And just let's tilt back to the days before the Model T. A good portion of U.S. farmland was used for transportation fuel for animal feed. So we're just flipping back a little bit.
Yes. Thank you, Mike. I think we're gonna stay on and run over just a couple of minutes. But again, for anyone who's listening, I do encourage you to take the survey that Salih's put into the chat. We'll also send that around via email. And Salih, I want to come back to you next, and Alessio, I'll come to you at the end for the same kind of idea. President Trump gave his State of the Union address last night. He's been encouraging essentially the concept drill baby drill here in the U.S. How do folks in the Middle East interpret what's going on with U.S. energy policy? Are they concerned about the U.S. opening up the tabs, bringing more supply to market? Is there potential for essentially like a market share war between the U.S. and the OPEC countries?
Well, that's a great question. And in fact, it is one of the questions in the survey. So I'm really very interested to see what everybody thinks. But generally, yeah, I mean, as I said before, I think one of the dominant drivers for oil prices in the next few years is going to be the fact that Donald Trump seems to prefer relatively cheap gasoline prices at the pump. And that, of course, trickles down to his policies. And one of those policies is pushing for higher U.S. energy production. I mean, when it comes to U.S. oil production, we still continue to think that the company policies, which are still very much focused on shareholder returns rather than growth at whatever cost, is going to be a lot more important. But given that pressure from Trump, if anything, they will be producing slightly more. But also important to note, I think, that a lot of the marginal growth that is likely to come from the US space is probably going to be geared towards natural gas a lot more than oil. So I think in the next couple of years, the marginal crude oil growth from the US is going to be limited. But that being said, I think this region, and perhaps you can say what OPEC and the wider OPEC plus group thinks, is that, I mean, as I mentioned earlier in the call, I think what they've thought for a while was that they knew demand wasn't very strong, and supply from outside of the group, including the US and especially the US, has been so strong that was the reason why they weren't able to increase their output. But on Monday evening, they did announce that they're going to increase. So they either think that supply from outside of the group, including the US, perhaps is not going to be as strong as initially thought, or maybe they think demand is going to be better than initially thought, or it's just simply responding to that pressure from maybe their outlook didn't change, but there has been that direct engagement from Donald Trump for the group to increase production. So perhaps no matter what they may be thinking about the rest of the group, they now will go ahead with their output hike starting in April.
Okay, Alessio, let's swing around to you. From a different angle, there's been a lot of discussion from President Trump and his administration about wind and solar, and typically not in a very positive light. And by the way, for everyone listening, Alessio and I work very closely together. He's essentially co-pilot on the wind and solar coverage from BI. So a little bit talking our own book here, but Alessio, give us a sense. You know, how do you read President Trump's view on wind and solar? Does it affect the market very much from your perspective?
Yeah, I think the theme of last night's State of the Union was the renewal of the American dream, and I do think the American dream does hinge on the energy transition, despite what's in the news. In order to, you know, reach AI data center targets and, you know, keep demand in line, you need cheap and energy that's fast to deploy, and that remains to be wind and solar. I think as long as, you know, we keep that in mind, you can't really get rid of the energy transition, no matter what he said about, you know, so-called windmills or how, you know, solar panels are ugly. But you also have to keep in mind that, yeah, a lot of jobs that have come up from the Inflation Reduction Act are in red districts. So, you know, how much does he really want to upset his base by kind of removing these subsidies?
Thanks, Alessio. We'll have to see whether our call turns out to be right this year, but we've worked in close collaboration with our colleague, Nathan Dean, who's based in Washington, D.C. And we think, despite some of the rhetoric, some of those key provisions from the Inflation Reduction Act, particularly the 45X manufacturing tax credit, most likely the ITC, PTC survive some of the tax reform discussion that's likely to kick off this year. So hopefully we're going to be right, but hold us to account if we're not. Mike, I'm going to come over to you for a last word. You also had hopefully an opportunity to see President Trump's comments last night. How do you think it generally plays into the commodity thesis? And we'll close there.
The most significant thing it's really affecting in terms of bidding commodities is the distortions in the bid in U.S. traded lumber and U.S. traded copper, which almost every trader knows those are short-term distortions, particularly as you turn on tariffs in the rest of the world. The key thing to note about what he talks about is tariffs. These are things that Robert Lighthizer pointed out in his book, No Trade is Free, 2023. And the significance difference, this is very similar to Smoot-Hawley in 1930. The difference was U.S. was a massive exporter then. Now it's the largest importer on the planet. It's being shut off. So in terms of commodities on a global basis, just look where U.S. is a glut. Crude oil, energy, natural gas, grains. Those have a problem. Everything else is a little more peripheral. Copper's in between. And to me, what I think is what Salih described is OPEC supply has been waiting forever, coming back on. What I see is almost a perfect storm for a bear market in crude oil. The president wants it lower. Supply-demand trends are unfavorable. So I see every rally is going to be sold. And now if we get that little weak unemployment number, which Anna Wong, our senior economist, expects in the U.S., that's a perfect storm. Every rally should be sold and expect crude oil to head towards 60 initially, and then get below what's normal in history, below break-even cost of production, which according to Bloomberg New Energy Finance, in the world's largest producer and exporter, a net exporter, is $56 a barrel.
Okay, thank you, Mike. We'll leave it there. Just to reiterate, please take the survey that we're conducting. We want to know what you think about the markets. We're happy to share our views. As hopefully is obvious here, we're all fairly opinionated and have forward-looking views on the companies and commodities that we cover. And if you haven't registered and you still want to attend our roundtable here in New York this afternoon, just shoot myself an ID or an email. We'll get you registered. Happy to host you. I know many of the regulars on this call are attending, and so hopefully that'll be a nice opportunity to network with us and your peers. So we look forward to being in touch, and we look forward to talking to you next Wednesday, same time, same place, 10 a.m. New York, 3 p.m. London. Take care, everyone. Hope you have a great week.